Hey friends, Lucian here with the Bullish Bears team. Wanted to make this video on bull call spreads. If you need more help with options or you're new to the world of options, make sure that you head over to our website at bullishbears.com and take our options course. And there's lots of different tutorials on how to trade all the different spreads like iron condors, credit spreads, debit spreads, all that good stuff. So again, this video is going to be specifically on bull call spreads. And again, you'll hear me say it over and over again in my videos because I try to teach the concepts overall, especially when you get into these spreads videos. You'll see several different names for essentially the same thing, and that's where I like to teach people from the very beginning to know the several different names so that you don't come across them later and are confused by it. So this is where a lot of new traders get tripped up because they hear several different names for the same thing, and it can be more confusing when it doesn't need to be that way. So that being said, let's talk about bull call spreads. Bull call spreads are also known as call debit spreads and also long call verticals, right? So take a screenshot of this if you need to, just to kind of remember it. If it gets confusing, just kind of get it over, look at it, study it, get it in your subconscious. So as you go along, these different terminologies kind of stay, go from subconscious to conscious when you start thinking about it with trading these spreads. Now, a bull call spread is a bullish strategy, and it falls under the overall umbrella of vertical spreads. Now, I'm going to show you in a second here. When you place the trade in Thinkorswim, it shows as a call debit spread, not a bull call. A bull call is more of your bias, or what you see it as on the chart, so it's more of the concept. But when you place the order, it shows in the system as a call debit spread, and it falls again under the umbrella of vertical spreads. And when you're trading a debit spread, you're actually buying a debit spread, so you're a buyer. And when you're a buyer, you're paying a premium or a debit. So think about when you're using your debit card in real life, money comes out of your account, right? So when you're, receive money into your account, it is a credit. So when you're buying, it's a debit spread. When you're receiving money back, it's a credit spread. So credit spreads and debit spreads, they fall under the overall umbrella of a vertical spread. So let's take a look and let me show you what this looks like in the real world. So I have a chart pulled up of Adobe. Let's go over here to an options chain. I'm going to show you how to place a trade at the end of this video, but for the sake of this video, I just want to show you from the beginning. I want to show you what this looks like, the concept of vertical spreads and call debit spreads compared to bull call spreads when you place an order. So when you place an order, if you go to an options chain, you see over here on the left side is the call side. Calls mean that you believe the stock is going up if you're a buyer of a call. If you're a seller of a call, you believe that the stock is going down. You're selling it to somebody else. So in this video, we're doing a call debit spread. So we're bullish, so we're a buyer. And I'll show you in a moment. It's a combination of buying and selling a call. But just look at this part right now. So we'll go to the call side of the options chain. If I right click and I go to buy, you're going to see over here, there's nothing that shows on the options chain, debit spread or credit spread. And there's nothing that shows bull call right here. There's nothing down here. That's because it falls under the umbrella of a vertical spread. So when I click vertical, you're going to see over here the strategy is a vertical spread, and you'll see on the order call debit. So you won't see bull call, you'll see call debit, which falls under the overall umbrella of a vertical spread. Confusing. It can be, again, when you add the terms bull call, that's where it can make things more confusing. Bull call is more of just the concept or what you're looking at. It makes it almost easier to see on a chart. It's kind of more of a better visual terminology than call debit. But again, just wanted to hopefully clear this up that when you place the trade, it is a call debit, not a bull call spread. But I'm making this video, we're going to call it bull call spread, but I also want you to know, what it actually looks like when you place the trade. So when you're doing a bull call spread, otherwise known as a call debit spread, you need a bigger move up in the underlying stock. It's a bullish directional play. With a credit spread, it's less directional. So when you're buying, right now, when you're buying a call or buying a put, you need a big move up or a big move down in the stock. When you're doing a bull call spread, it's a combination of buying and selling an option. So you don't need as big of a move in the underlying stock as you would just buying a straight call or a straight put, but you do need still a bigger move in the direction of the stock. So if you're bullish, you definitely want that stock to move bullish. So you do need a bigger move in the underlying stock, whereas with a credit spread, it's less directional. You do get more even risk reward than you would with a credit spread. Now with a credit spread, there's definitely more risk, but in less reward. However, you have a higher probability of profit. With a debit spread, there's less risk, more reward, but lower probability of profit. So the odds are more in your favor as an option spread or as a seller because, that would be credit spread. So the odds are more in your favor as a seller, and that would be doing a credit spread. They're not as much in your favor with a debit spread because remember, options are decaying assets. So if you're an option buyer, the odds are less in your favor of success. So credit spreads give you a higher probability of profit compared to debit spreads because with a debit spread, you need to be able to choose that direction of the stock. So let's talk about naked options for a moment and buying further out of the money. When you're buying out of the money, you are buying time, otherwise known as theta, and you need a big move on the stock. So when you're buying naked, every day that time passes, you're paying to be in that trade. With debit spread, doing a debit spread, there's a little bit less exposure to time decay due to the short strike. But again, you still need that stock to move. So when doing a debit spread, it lowers your break-even point. There is a more even risk reward profile. You do, however, cap your gains compared to buying naked options. So if you're buying a straight call or a straight put, you do cap your gains. However, again, your risk is better than compared to just, with doing a debit spread than buying a straight call or a straight put. Your real risk is your debit amount. So that's what you would potentially lose on the trade. And you want to take profits around 55 to 65%. Do not hold debit spreads until expiration. If it expires in the money and you are assigned, again, a lot of people kind of freak out if they're new traders. Oh my goodness, what happens if I get assigned? It's not as scary as you might think. If you are assigned and you do not have the money in your brokerage account, your broker will sell the shares for you because, again, they don't want to be on the hook for something if you don't have the money. So they will sell for you. However, if you do have the money in your account and you're assigned, you will own those shares of the stock. So you could just sell it out to the market. So it's not as scary. But, again, you don't want to hold because anything can happen to that stock. So it's best to take profits around 55 to 65% and do not hold your spread until expiration. So with a bull call spread, otherwise known as a call debit spread or a long call vertical, again, it's a bullish play. You are buying a call and then selling a call further above out of the money. You want both strikes to expire theoretically in the money. Again, I'm going to show you what that looks like. So at expiration on a bull call, you'd want price to be above the short strike option, which is the option that's sold. So that's how Both options would be in the money. However, you do want to sell again at 55 to 65% of profit. Do not hold until expiration. Now, a popular way to buy a bull call spread is to buy one in the money and then sell one out of the money. And the one that you buy has intrinsic value, and the one you sell has extrinsic value or time value. Now, you want to buy the strike that you think that price will stay above. Now, your sell strike lowers your entry price and your break-even point. So again, at expiration with a bull call, you want price to be above the short strike or the option that's sold. But again, sell at 55 to 65% of profit. Do not hold until expiration. Another way that you can do a bull call spread is to buy one at the money or out of the money and then sell one out of the money. It's less risk and more reward. However, it's less probability of success or probability of profit because you need a bigger move in the underlying price of the stock to break even or profit, and you have much more exposure to time decay, so you need a bigger move in the stock to move more in your favor. So with a bull call spread, again, otherwise known as a call credit spread or a long call vertical, you profit as long as price stays above the break-even price of the debit, and you will receive max profit if price is sold or if price is above the short strike or the sold option at expiration. However, again, sell at 55 to 65% of profit and do not hold until expiration. So let's take a look at a real world example of Adobe. So again, this is more of a directional play. So you need the stock to move either up, obviously if you're doing the bull call or a call debit spread, or down, if you're taking the inverse of that. But you obviously got to see these stocks, these bigger stocks, they move with the market. So you'll see if I pull up a chart over here of futures, futures are kind of right at the base of angular support, kind of trading sideways. So finding a bullish directional play right now in a market like this is a bit challenging, especially I'm making this video on a Friday. It's been kind of trading sideways near support level. So again, this is where you don't want to trade just to trade. And it's, these debit spreads, they are more risky because you have to find the direction of a stock. So it's been a little bit of a challenge to try to find a stock that I'd be more directionally bullish on. But I had to find something for the sake of this video to try to show you an example. So we're going to look at Adobe, right? So with Adobe, you can see the overall kind of the trend of the stock is moving up. It is near resistance levels, right? But let's just say, for the sake of this video, we think Adobe is going to continue to rise, right? So what we want to do is pick the strike that we believe Adobe will stay above, right? Now, we have videos that tell you, in our next level content section on our site, we have a whole video library that tells you how to trade all the different spreads, what strikes to look at, all the different ratios, all that good stuff. So if you want to find out how to do all that, you can upgrade to our next level content. This is going to be specifically just kind of how to buy and sell a debit spread, the concept, how to do the order entry. But if you want that, you can always upgrade to our next level content. So again, let's just say for the sake of this video, Adobe is going to continue to rise, right? So let's go and let's just say that we believe Adobe is going to stay above kind of this, this 261 level, but let's say to be safe, let's say $260, right? So if we go to the trade window over here, let's say we're going to say that Adobe's going to stay above 260. So the one we'll use right here, we would buy the 260. So I'd click on the 260, and then I would hold down the control key, and let's just do the sell the 270. So I would click on the bid side, hold control key down, click right over here on the bid side, and you'll see 260 to 270. All right, so now let's do confirm and send, and let's pull up the order box, and let's break this down. So let's take a look at max profit first, $432, right? you'll see that the debit amount's kind of changing, going up and down. How you calculate max profit is take the width of the strikes, which is $10, which is 270 minus 260 minus the debit received. So take, $10 minus, let's say 5.63 equals 437 times 100, because 100 shares in one options contract times 100 equals 437. That's just because the debit amount keeps going up and down as I'm making this video. So that is the most that you could make on a debit spread. But again, you're not going to look to make max profit, because you're going to get rid of this at 55 to 65% of profit. The max loss that you can make is the amount of the debit that is received. So $5.68 times 100 shares, because again, one options contract's 100 shares, and that's how you come up with $568. And how you come up with the break-even price is you take the strike that you bought, that 260 right down over here, and you add the $5.68 to it. So 260 plus 568 is $2 or $265.68. So that is your break even. So again, ideally or theoretically at expiration, you'd want price to be above that 270. But you're not going to hold it to expiration, but you're bullish, so you want price to rise and get above that 270, so that both of these options contracts would be in the money. That's how you would theoretically get max profit. However, again, you'll take profit between 55 to 65%. If you want to make more money, do not change your strike prices. Change the amount of contracts that you purchase. So let's go out and place an order just so you can see how this is done. You'll see I have my virtual account pulled up right now. Again, we highly suggest paper trading options or even stocks. If you're new, always paper trade for months and make hundreds of trades first until you feel comfortable and you're a successful trader. Do not trade with real money until you are a successful paper trader first. That's a perfect way to blow up your account, and that's what we're always trying to teach, the proper ways to trade in our community. So now that that stipulation is out there, here's how you place the trade, right? So now you'd come over here. Again, I already have the order built on Adobe, confirm and send. And let's just, again, always confirm your order, make sure it's correct. Let's send it out. And, it takes in the real world, it takes a little bit to place the trade. But for this video, or if you're paper trading, if you want it to go through quicker, you could just go up to Monitor tab up here, and you'll see I did a limit order. Again, you can do a market order. We only suggest doing that on higher price liquid stocks. Don't just randomly put market orders out there. But for this video and for practicing, just to show you, we would just right click. Because this order is working, it hasn't been placed, I can do cancel and replace, come down here to limit, change it to market, confirm and send, boom, and then voila, it sends it out to the market, right? Just to show you a way to the differences with limit orders and market orders and how to do the trade. Again, this is a practice trade. I just want to show you how this all breaks down and how to place, a bull call spread, otherwise known as a call debit spread. So now you can see here, if we go to the Monitor tab, here's my position in Adobe right over in here. So once I open it up, you'll see right here, there's my position. All I need to do to close it out is collapse it, right? So don't have the arrow open, collapse it so it's collapsed right here. Right click, create closing order, and now we're going to sell the vertical. Remember, we bought it originally. Now we want to sell it and buy it back, right? So now we would just go and sell it. You would obviously confirm your order, make sure it's proper, don't rush, confirm and send. But again, for this video, I'm going to send it right out, and you'll see it's taking a bit just because, again, it's a limit order. And I'm in my virtual account. So let's just go up here. You can see the order's pending. It went from green before, now it's red, right? Trying to sell it. Let's just cancel, replace order. Let's change it from limit to market. Again, just for this video, it's just showing you for purposes here, make sure you do limit orders and go slow on your trades. Confirm and send. And voila, there you go. It's sold to the market. And if you go back to the monitor tab, open it up, the position is now gone. So that's how simple it is to place a bull call or a call credit spread trade. I meant to say call debit. That's what you'll see when I make all these videos. This is where it gets confusing. When I put all the terminologies into one video, then I end up confusing myself at times. So this was a bull call or a call debit spread, not a call credit. So I think I just said call credit. So don't, it wasn't call credit. I meant to say call debit. Bull call, call debit, right? So again, if you need more help with options, make sure you take our options course on our website over at bullishbears.com. The link will be below. And if you like this video, we greatly appreciate it. If you like it, share it, post any questions or comments below. And so again, hopefully this video helped you, and we will see you in our community. Enjoy.